What's up, everybody? We're going to be taking a look at, well, probably the most important chart, or at least the chart that everybody's staring at all day, every day, right now, the S&P 500. This is our weekly market overview, but right now, S&P is the show. S&P is the thing that everybody's most worried about, and so we're going to dig right into it. Now, if you don't already subscribe, please subscribe to the channel. You can also go to macro-ops.com and subscribe to our free newsletter where we cover this stuff multiple times throughout the week. So what we're looking at here, get these things off the chart, is a weekly chart of the S&P 500 going back till, well, September 20. Let's go back into the great, exciting beginning of 2020. And I'm going to kind of take a second here and start. We'll come back to this chart because there's a lot going on here, and I want to make sure that we see what it is that we're looking at. But I want to start from a place of a more clean chart here. This is an S&P 500 chart of the futures. Each bar is a daily bar, and that's the top part. The bottom part, we have what's called the SQN indicator. This is it measures the volatility and direction of the underlying market that it's attached to. We have, I'll back it up here. What it does is it measures the last 100 days change to change. So if yesterday was like a, negative 1% day and today was a negative 0.5% day, that's a 1.5. So the change was 1.5%. It measures that, averages it out over 100, and then square roots it. So you get a small number. Okay. So what this represents, I've got 5 colors here. Okay. And it's kind of hard to see all of them because one color only happens maybe once a decade. Okay. But if you go through and look at this chart, you can see that we have a lot of green, yellow, and blue, right? And the S&P 500 has gone up quite a bit. So, green, yellow, and blue represent different bullish or neutral market regimes. The red is the bearish market regime. And then if we really scroll deep into it, we can find an instance where it goes very dark red. It's called crimson. Okay. This period represents a major market crash has happened and usually marks a very significant bottom. For the most part, these don't happen all that long. This was back in 2018. We can go back to the global financial crisis to see the previous example. And again, it didn't really happen, but boy, was that was that an understatement. So it's so rare that it the move down takes so long, and when it actually happens, it mostly signifies capitulation, not anything else. And it still took a while to recover. So let's go to where we currently are. And the other thing I really want to point out here is this thing really spends the most amount of time. This was the March 2020 period. This thing spends the most amount of time in the yellow, green, and blue. Yellow is neutral. That means it's just kind of trying to figure itself out. Green is considered bull quiet. That's a nice rising calm trend. And then the blue is a much more highly volatile, very fragile type market. We'll take a look at this one over here of February to April of 2024. It bottoms in October 2023, kind of is that after, a quarter of selling, and it just goes up almost day after day after day after day. We go from 4,500 to 5,500. So like a 20-something% move higher. And what happens is as we rise over and over and over, that price gets fragile. So it's not a stable price once you get that far away from, from kind of where it would be a little more normal. A 20% move in a few months is not a really common move in the market. It happens plenty of times. Maybe a better way to say it's more of a fragile move in the market. And so when that happens, you get this blueprint on the histogram down there. And that blue is just saying, hey, we're in a highly fragile, volatile bull market. And the way we wear that out is we either go sideways for a while or we have a steep decline. And we kind of had both here. So we had a decline. Now, again, this was back in 2024. We had a decline of, let's call it 8% on the 7%, 8% on the S&P 500. We also had a period that pretty much didn't do anything for about 3 months, right? So our peak here, March to June. So about 3 months of sideways action. So it really does represent that absorption of the fragile volatility. So this price levels, you can see when it started to get fragile over here, that's about where we went down to, and we started to fill out that fragile area with, back trading through it to see if it really was any good, got our breakout, our pullback, and then continued on higher into the summer. Leads us into the summer. We had another little, now this one was small. This happened quick. We first February, and we got out of it in April. So like 2-3 months of sitting in this bull volatile, very fragile area. This one took a week, and we corrected. And the August correction on the S&P was over 10%. Pretty quick, pretty steep, but the recovery actually was pretty quick and pretty steep. July until September, so about 2 months wearing it out sideways. Notice that it comes back into the previous area to retest again, gets more support into here, and then it's back and on. And so this print right here is about as close to it as it could be. And it's a weird looking print. This is about, you had some good big run-ups, because remember, this is post-election. So big thrust, kind of sideways, and so it didn't print that bull volatile top, but we're definitely in a fragile environment. The higher this number is, the closer you're above 150, the more fragile the market becomes. So it's kind of, even though it didn't print blue, it doesn't need to be printed blue because, I can do this, go to the SPX, and we've got blue. Okay. And so it's kind of, it's right there. It's one of those edge cases. And something about trading is precision. Like if you're really trying to get that exact decimal, 100th decimal place to work out for you, oftentimes you get knocked out because of that type of thing. Okay. So let's take a look at where we are right now. Okay. The great thing about what market regimes are, and that's what I use this tool for, it gives me an idea of the market regime. So blue equals bull volatile, green equals bull quiet, and I'll have this on there. Red equals bear. Okay. So I'll make this a little bit bigger too. I'll try to. There we go. A little bit easier for everybody to see. Okay. So what we're doing with this market regime tool is it allows us to measure where we currently are to previous areas of that type of price action. Okay. So if we're always looking at this, if we're looking at this and we're thinking to ourselves, wow, this is going to be worse than the March 2020 crash. This is going to be worse than 2018. This is going to be worse than the global financial crash. This is like the 1987 crash. Okay. We can go and compare the market regimes at those periods of time, but they're likely not going to look anything like this. Okay. What I want to do instead is I just want to go look at other periods of time that look like this. So I'm not comparing it with my bias of, oh no, this is it. This is the major one. I just want to go look at all the other times that this happened and start to figure out, okay, are we in a place where I should be preparing for, zombie apocalypse, or am I, do I need to wait for more information to figure that out? So right now, we've basically come from a pretty extreme high back in March 2024. And even though we have been wearing it out, we continue to get new all-time highs. So let's first take a look at however many times were we above. Let's put a horizontal line at this level to see if we can see, because that's the most significant peak right now. Okay. That peak right there in the spring of 2024 was a very high level for this SQN. So I want to go back and just take a look. Okay. When was the last time we had that look? Okay. Well, actually, that was January of 2018. So another January, like, a similar time frame. And what happened immediately after that? Well, we had this thing called Volpocalypse. So let's go take a look at this time period. We had this immediate crash, and that was a 10% crash. Okay, so we've also achieved not a crash. We have a 10% pullback. Okay, we've also received a 10% pullback here. And when it actually bottomed, it continued to go higher into the next bull volatile regime. And then that was a lower bull volatile. And that, even though price was higher, and that actually ended up being a full 20 something percent. I believe it was a 20%, 19.9%, something like that. Almost a full 20% bear market correction, which again recovered it immediately. So a similar sort of scenario there. It doesn't look to be too similar. Okay, let's see if there's another example of where price got up that high again. Yeah. One other time in history has the SQN indicator ever been that high, and it resulted in an immediate 10% correction. We got our 10% correction. We got another one after that, and we're having another one right now. So it doesn't look like we can really compare the two. This looks like its own incident of 2024. And, the financial conditions, the economic conditions are a lot different than in 2018. This period was because it was such a steady, you want to see what happened. This was the election. And then the next 2 years was just a straight grind higher. And eventually we got to that extreme fragile area that would cause that. And so there was just everybody was shorting vol. There were some products that blew up, and TLDR, that's kind of what happened there. So I don't see it's kind of hard to measure what we're looking at right now as that. I don't know if there's a product on the market like we had in 2017, 2018 that was that fragile, the short vol sort of thing. But anyway, that's our only instance that we could really look to it. At least in the last 26, 25 years. We could take a look. This is a weekly chart, and we can go back and see what was our setting. Let's call it 330. We'll do a horizontal ray. Nope. Horizontal line at okay. Looks like it 2011. Didn't happen in the global financial crisis. 1995. And so if we look over here, it seems like the setting is a bit different. Probably has to be. So maybe we'll look at, yeah. Okay, I'll come back to that chart. But while we're looking at it, it doesn't appear to be of significant risk. Next thing I want to look at is, okay, so we are in the neutral market regime. When we've been in neutral, it typically, a move that causes a crash goes from volatile to neutral to bear quiet very quickly, right? The ones that dip, the crashes that happen, the instances of crashes that actually happen are very steep. So let's go take a look. That is not steep. That has been, if we can look at the slope of that, it's it's kind of like that. Let's take a look at the crash periods that we're so worried about. It's just straight down. It's this one was a little bit whoops. This one was a little more drawn out, but nothing like the one we currently have. And then again, this one was pretty steep. So if we just look at the slope, and let me hide, we can just compare apples to apples here. Kind of, you can see the slope, and this is a very broad slope. So for me, it's not a concern as a spike right now. It's just more of like a similar sort of like weakening top. But that doesn't mean it's not anything. So after we leave, when the other thing I like to use these market regimes for is to identify what type of trading strategy we want to be in. So there it goes. When I'm in the green, the bull quiet environment, I want to be trending. I want to look for trending type trades. So I want to be either buying dips or buying breakouts as it rises. Okay. That's how I want to be trading in that environment. And you can see it just rises. As we get into a neutral environment down here, this is where I either want to be, I want to be trading mean reversion. So I want to be looking at places to buy down in here. And we're actually getting some good levels to consider. We've got my mean reversion strategy is down at the bottom of these bands, these channels. And so I would be looking for a move back up into, somewhere up into this area right over here, maybe the 6,000 level. We could even see a move, that kind of comes back, takes some time and starts going that way. So down here, I actually want to be looking to buy. I don't have a whole lot of more conviction to the downside. It doesn't say that downsides are obvious to me yet. And so that's where I'm looking. I'm looking for a move, probably back up into, take that out, back up into the middle of the area here. And who knows what we see there. So I'm going to throw on my, let's do periodic. And we're going to take a look at the annual volume profiles, hopefully. Okay. So there's something that was interesting. When we're looking at volume profile, we want to make sure these low volume areas get the volume that they deserve and they get tested. And we typically see prices go to higher volume areas, right? So today we got down into this high volume node of 56, whatever it is, somewhere from like 5680 to 5650 area. Today got down to 5673. So that's right into that support area, this high volume node. And we reacted up off that pretty strongly. That is let's see how much of a move that is right now. That's a 1.5, about a 2% move on the day off of that support level. Okay. So it doesn't mean that we have to go there. So using good risk reward here, instead of just buying it and letting this go against me, I know where my stop would be placed if I'm wrong. I know where I get in. I'm going to get pulled into the trade, letting the trend, when it starts moving in my direction, I want to buy. I don't want to just put a magic limit order down here and hope I'm right. I want to let the price, because I'm sure we're going to get some more volatility to get back down into this area, but it should resolve itself back up into the higher volume area maybe somewhere up into here. Let's look at the point of control, 61.31. And let's measure this trade out real quick. Let's say we we buy above today's high and stop below today's low, and we move all the way up to the point of control. It's about 2.75 times our risk. So you risk $100, you make $275. Multiply that by whatever you risk, $10,000, make $30,000, whatever it is. That's the idea. That's what I'm looking at. Now I'm going to go and take a look at a few other things that lead me to the idea that I want to start considering buying in this area. Okay. First things first, let's take the SQN up. Okay. So what we have here is the S&P 500 on a weekly basis. What we have down below is the New York Stock Exchange advancing issues, 1 week chart, but that's a 10-week moving average of it. This is what it looks like without the averages. You can see why I like to have the average on there, because it cleans it right up. Every time we get down to this bottom area, this bottom dashed line, it has always been a good buy area, okay? And if it goes further, you end up having a bit of a crash, but that crash also ends up being an excellent place to buy. So if you bought the first time it gets into here, you're buying at S&P 2638 before it goes to 2300. So a 10% decline from your entry, you got stopped out and you have to re-enter, right? Happens over here, same sort of thing, 2,900, this thing goes down to 2,000. So you don't just go off the idea that this is a great place to buy when it's down here. It's just confirming or non-confirming. It's just evidence to tell you, hey, this is usually a good spot to look for reversals higher. And then we go look at the different spots through here. So, there's times where it comes down into here and it bottoms like here, and then goes from, what do we say, like 3,600 to 4,300. Here bottoms at 3,500, and then, the next time it gets down, it just you never felt pain. 3,600. Actually, this is the other thing, when it gets all the way down to that very bottom area, that band, that is a major market bottom, and you usually will never see that low again. You can see that happen in March 2020 at 2,100 on the S&P. It happened in October of 2022 at 3,500 on the S&P, and we've almost doubled from the 3,500 level. Well, not double, but it's 70%, 80% off that level. We've certainly so like 200% off that level. So if you ever get down to this bottom area at about 1,000 on that band, you want to be buying with both fists. That's the place to buy, and that's the hardest place to buy. Nobody wants to do it. Everybody thinks the world's going to end. Nobody ever thinks that it's ever going to recover, and that's typically the major bottom. But we get these more common bottoms throughout. Here's let's take a look at the August crash that we had last summer. Didn't even, we're lower than that right now. So we could end up with a major crash, which would just give it, maybe it's a 10% lower move. Great. As long as we're not putting our entire portfolio on market bid, we use good risk management so we can be wrong when the evidence is in our favor and we have high probability trades. We would like to be in those trades. And if even with high probability, we want to make sure we have good risk management so that if we're wrong, we lose a little bit of money. And if we're right, then we can if you're right, when you got into your trade over here at, by the way, I ended up getting long at like 2,600. The low was at like 2,100. So it was 500 points higher before I actually got long. I didn't just get long because it was in that area. I had reasons. So anyway, this is what we're looking at. This is how it's shaping out. So back to the idea, I'm looking for a long move next week, sometime, somewhere from down in this range for a move back up inside the range on a mean reversion setup. If that ends up being the bottom, absolute bottom of 2025, and we never see that low again, great. I will have gotten into a trade and excellent. It doesn't matter. It's just one of many, many trades. So real key importance here is that it's all about risk management. Don't risk. Just one quick point. If you bought, even at 2,500, this thing is more than doubled, and there would have been plenty of opportunities to add to your position to get there. So you don't have to put the risk on that's going to blow you up on every single trade. Use good risk management. Stay in this environment. I don't always do S&P 500. I like to go through the entire universe of all the currencies and commodities, bonds, ags, metals, energy, everything. I like to go through them all. Crypto. I like to go through all of those normally on these weekly market overviews. But this is just one of those times where the S&P is the most important thing out there. The final thing I want to take a look at here is we were pulled out of this environment. Let's take these off. Our swing beast strategy took us out of everything back in December before all of this stuff happened. So we get long back in September at, let's say, 5,800, right it up to 61.30 or so. Let's see, it was 58.47 to 61.27. That's great. That's neato. We caught a good move. We caught the move prior to that too. Moves. We caught all these moves. What most importantly is this entry that we got to in September took us out before all of this pain. The drop from here to this morning's low was 7.5% or so. That was our sell signal all the way up here, selling at 61.20, let's say, 600 points higher than where we were this morning. So having the right strategy in the right environment and getting out of it when that environment shifts, right? This environment has now shifted. You can see the decline, right? As that environment has shifted, we got out and let all this play out. I'm going to take my mean reversion trade. If I get filled on the trade, I'm in, and it may shift over into another trend trade. That's all I got. I'll see you next week, and we'll probably dig deeper into some other stuff. Have a great weekend. Have a great week ahead. I love you all. Bye.